It was just over a month ago when the stock market was in free fall, volatility had skyrocketed, and there was gloom and doom everywhere you turned in the headlines. Fast forward to today, the stock market's in a much better place. Volatility has significantly dropped off. And the big question is, how did that happen? Well, in today's video, we are going to answer that question along with the even more important question, which is, what is next? Let's dive into it. So my name is Will Allen with Centera Capital. We are an independent registered investment advisory. I started in the business in 1998. I worked at Merrill Lynch and Wells Fargo for the first kind of 10 years of my career. It's taken me a little while to get the stain of that off, but now that I have been independent 18 years, this has come into play to help guide clients through the markets we've seen over these last couple months. And if you flash back just a little over a month ago, the stock market was in a literal free fall. We had the S&P 500. It declined over 20% in a very short period of time. We also highlighted at that time the volatility index, known as the VIX, had skyrocketed up to over 52. That was the second highest close it has had in the last 15 years. What did that mean? It meant there was a lot of individuals and institutions panic selling and bailing on the markets, as they often do. If you want to play-by-play for all the reasons behind all that, you can go watch some of our previous videos, because we were coming out with videos every couple days to help guide clients through what was happening. But we said that a lot of times when you see volatility reach such high levels, a lot of times that can be the lows in the market. Well, here we are. And by the way, we had some pretty nasty headlines. I'll throw up one here from the Wall Street Journal. Dow headed for worst April since 1932 as investors signal no confidence signal. That's enough to make you want to jump out of a tall building, right? Well, not so much. We help guided clients through this, and let's fast forward to today and look at the S&P 500 now. It is up over 5,900. You can see there it is recovered. Not all of the sell-off, but a lot of it. And the reasons for it are a couple reasons. Number one, the administration has had a change of tact on the tariff front, right? Which we knew, hey, very likely they were going to be negotiation tactics. You can definitely pick at the way it was done and say, hey, could have done this better, and we agree there. But the fact is, we knew deals would eventually start being reached. This past weekend, we had a deal with China that was massive. And really all you need to know about this is this fact. China, for the next 90 days, reduced their tariffs against us from 125% all the way down to 10%. That was a shocker. No one was expecting them to make such a huge concession in their meeting in Switzerland. That tells us that they need a deal. This was really damaging to their economy because we buy so much stuff from China, and when tariff rates were at 145% we had against them and 125% them against us, there was just no business taking place. The other fact that has been very helpful in this market recovery have been earnings reports. You know, one thing that we try to hit hard at over our videos over these last few years is that in the long run, the stock market goes where company profits go. In fact, just a few weeks ago, in our last video, late April, we said for the first quarter, profits for companies in the S&P 500 was projected to grow at just over 10% year over year. We'll take a look now, and you will notice that this is 13.6% growth now. That is really tremendous growth. That's following up on the fourth quarter, where profit growth was 18.5% over expectations, or 12. So when you get strong growth in profits like this, that supports higher stock prices. So a lot of good news over the last couple weeks. It's taken the markets, for one, where you had investors and institutions bailing, to now a lot of those people are trying to scurry back in because they missed the rally. Our clients didn't bail out. That's one of the main reasons they have us here for. So about 6 months or so ago, we were just shy of 100 subscribers in our channel, which we do these videos for our clients. But if other people can listen and learn from them, then that's great as well. And we said, hey, if you aren't subscribed, go ahead and subscribe, and that would get us over 100. We appreciate it. Well, we have had a lot of subscriber growth of late, and we are now over 800 subscribers, but still many who watch this channel aren't subscribed. And during months like last month, when we do a lot of videos, you want to make sure you don't miss a video. So if you haven't so far, hit subscribe and then go turn your notifications on. So every time we have a video, you get notified and you can watch it. You won't miss one. Thank you very much. We appreciate it. All right, let's talk about another category or topic that is very important here, especially with the tariff discussions, and that is inflation, because there has been some concern that, hey, with the increase in tariffs, that could cause inflation to really go higher. Well, yesterday, and we're filming this on a Tuesday, yesterday we had Consumer Price Index, the CPI, and that came out, and very good news. Came in at 2.31% year over year. And that was a lot less than what economists were forecasting. And up on your chart here, we have not just the CPI, we also have something called the PCE, which is the Fed's preferred measure for inflation. And you'll note that is at 2.29%. So not down yet to the Fed's 2% target, but you can see that it is getting close. And the fact is, if our administration had not talked about potentially firing Powell, there's a case to be made that rates should have been cut, given that the Fed right now has the overnight rate up at 4.5%. Typically, you're not going to have rates that high when inflation is so close to the 2% target. But nonetheless, we're going to continue to be watching in the coming months to see if the inflation rate does start to go higher. One important fact is this: the tariffs apply to goods that we are buying from countries around the globe. We had a chart in our last update that showed that most of what consumers spend money on now are services, okay? So travel, going to Disney, going out to eat, concerts, those kind of things, right? And that's not really impacted directly by the tariffs. Spending on goods, if you're buying a computer or a TV, yes, that can have an impact, but that's a much smaller percentage of where we spend on today than it was 30, 50, 70 years ago. So we like the outlook for inflation. We do not see it going back up to 3, 4% like some do. Now, the other chart that goes alongside of this that is good news, this is looking at real average hourly earnings. This is looking at, for workers, how much are you making versus last year after accounting for inflation? Because that's what matters most. Are you gaining on inflation? That number came out yesterday also at 1.44%. And you can see that's up near its high over the last couple years. In the past, when we've been going into a recession, this number has rolled over and gone down into the negative territory. You can see there is no sign of that happening now. So again, in April, everywhere you turn, there was talks that a recession was imminent. We are not seeing that either in the economics data, in the jobs data, and from what we're hearing from companies, that is very positive for the outlook for the stock market. Now on to rapid fire, where I go over some charts that I think you need to know about. We're going to start off talking about the first quarter GDP report that we got that came in at minus 0.3%. Now this is measuring the economic growth rate year over year after inflation. And we said in our last video that this was likely to be negative, but don't go worried about recession just because you see that. Very similar to the first and second quarters of 2022, which when GDP came out for those quarters, they were negative as well, but that was not called a recession. And we're going to show you why today. Because what we care most about is consumer spending and business investment to drive the economy. When consumers are spending money, People maintain their jobs. There's good jobs growth. But sometimes you get negative GDP when you get a big adjustment because of trade. In early 22, that happened. We here in the US bought a lot more from other countries. That's how much we imported than what they bought of us, exported. That comes off GDP, so it's a negative number. So early 22, that was not a recession, and we don't think this first quarter will be either. And here's why. The GDP number was minus 0.3%. But there is a category of GDP called real final sales to private domestic purchasers. That is a mouthful. Here's what you need to know. This is consumer spending and business investment. It takes away trade, takes away government spending. That came in at 3% year-over-year growth. That is fantastic. And you can see that's right there in line with where that growth has averaged over the last several years. So this is very positive. This, by the way, backs up what we've heard from companies where we saw strong profit growth. Companies had good outlooks, most of them across the board. And so first quarter GDP growth for consumer spending and business investment at 3%, that is the key takeaway from the first quarter GDP report. Now, let's talk about two charts that we are monitoring carefully. This is not as good a news as what we've been talking about so far. The first is looking at the interest rate on a 10-year Treasury yield, okay? And here you see that it is 4.45%. That was the close as of yesterday. In real time, this is up to 4.5%. Now, this is notable because what caused the pivot from the administration on April 9th to go to 90 days, roll back the tariffs on everyone but China was the yield on 10-year Treasury went from 4 to 4.5% in 2 days. When we did a video, we said this is very unusual. This is dysfunction in the bond market. This is of major concern. And the Secretary of Treasury went in and got the pivot on tariffs. Well, after that announcement, that rate went from 4.5% down to 4.2%. You can see there over the next 2 years. Well, this has been in an uptrend ever since and now is at 4.5%. In our 2025 Outlook video, we said we don't want to see this rate go up to 5 and above and stay there. So we're going to be monitoring this in the weeks and months to come. We would like to see it in a range between, say, 4 and 4.5. If it goes up above that, that could be a stumbling point for the stock market. Okay, the last chart here, looking at Small Business Optimism Index, the NFIB. We've highlighted this a few times over the years. This asks over 10,000 small business owners every month a series of questions. This is how much optimism do you have around your business in the upcoming 6 months? This spiked after the election up to 105, which was near a 6-7 year high, but has been in decline ever since. This came out just a couple days ago at 95.8, which is still a lot higher than it was for much of the last 2 years, but you can see 4 straight months of declines. We know that these small business owners are concerned with the tariff issues, especially with China, but also Vietnam and some of the other countries over in Asia. So the big question is going to be the China deal that was reached to have the 90-day pause there. I am betting that next month we see this number go up, but we'll just have to wait and see for the details. But here's the big takeaway. Going out over the next couple months, we want to see small business owners' optimism increase because then they'll do more hiring, take on more spending, and that can be a real boost to the economy. So the fact that it's down 4 days in a row, that is not ideal. So the key takeaway today is that the market environment could not be more of a 180 between last month and this month. The stock market has gone much higher. Volatility has come way down, and those scary headlines are mostly gone. Never going to get rid of all of them. The other good news is that corporate profits have come in much stronger than expected, and guidance has been pretty good as well. And then lastly, on the inflation front, we had the best year-over-year inflation read reading in over 4 years. That's going to be something we continue to watch in the months to come, but this was a good start. Okay, if you have not seen one of our videos before or you're new to Centera Capital, you can go to our website, centeracapital.com. You can reach out to us. We have a 3-meeting process to see if we are a good fit. And like I mentioned earlier, we're just having fun with the subscriber counts, but if you haven't subscribed, go ahead and hit that button. Get us over to 1,000. We'd appreciate it. Thanks for watching and take care.